we are going to talk about the 5 most expensive 401k mistakes employers make.
Right. We're going to start with the one mistake that triggers more audits than any other.
Okay, so mistake number 1, missing contribution deadlines.
The reason why this is such a problem is because it has to be reported on the Form 5500. More often than not, this is not an intentional thing. Payroll gets delayed, somebody's on vacation, somebody's sick, somebody got jury duty or whatever, or cash flow gets tight for a day or two, or there's not a really good written down process and nobody's sure as to who's supposed to be doing what. Once contributions are late, there are corrective things that need to be done. Okay, a little bit of extra money needs to be put back in, etc. Are there some simple or straightforward and quick solutions? Yeah,
Absolutely.
I've got one of them that are technology based and Catherine's got one that's paper based. All right, better payroll vendors. It's amazing if your payroll vendor doesn't offer a way to help get data and reports to your record keeper. Maybe look for one that does.
And to explain that simply is you can have a payroll vendor where you run your payroll and they take the money out of the employees' accounts and they send them over to the record keeper.
Right.
And it's done with a file and it ties it together and you don't have to do anything more.
Now then, there's also 360 payroll integration between payroll vendors and record keepers that help with that. Or maybe you've got a 360 payroll integration, or you're trying to, and you got a good payroll vendor, but your record keeper can't handle that. So maybe look at that.
So
what
good
was your paper solution?
I would say old school. Just do a repeating reminder on your calendar. And if deadlines are being missed, there's usually another issue happening at the same time.
Right. Mistake number 2.
Skipping employee eligibility checks.
Right. Now, mistake number 2 is failing to properly track employee eligibility. So whether or not somebody's worked enough hours, been there enough months, hits the service requirement, and then they end up never getting in the plan because you never gave them the information about it. You didn't do an automatic automatic deferral. Now, this is also a very big problem when it comes to new long-term part-time employee rules. Okay, we got to make sure that the employees have been with you for a couple of years, that have worked for over 500 hours, that otherwise aren't in the plan. They need to be able to defer as well. All right, so when this gets missed, retroactive contributions and corrections can become very expensive very quickly, depending on how many people you've missed for how long. Okay, now then, so are there solutions to this? Of course they are. Now, funnily enough, they're actually very similar to number 1. Does your payroll vendor help keep track of eligibility? Does your record keeper help keep track of eligibility? Okay.
And do you know your basic eligibility rules?
And then, well, that's it. Well, and then the next thing is make sure you understand what the document actually says, what eligibility is, not what you think you remember it was a couple of years ago.
And this starts to affect more than just contributions. It grows.
Right.
It affects how the entire plan is structured.
Mistake number 3.
Poor plan design affecting taxes.
Right. Now, on paper, the plan works, but in practice, it could be costing the business tax advantages they could be using or creating problems they haven't seen yet, okay? This is where employers think they have a compliance issue when they really have a plan design problem. Okay, so now we're going to very quickly distinguish compliance from design. Now, compliance has us, like the TPAs, doing things right as long as it's legal, but we're following the design, but the design has not been made sure that the plan meets the needs of the participants and or the employer. Maybe there isn't Roth. Maybe people are coming in too quickly, or people are taking too long to come in, or we got some issues with the employer contribution. So some of the design changes that can upgrade the plan, remember, it's going to be the same 401k plan, which is going to change some of the features. Does the plan have Roth? Would your employee makeup really benefit from a discretionary match or a safe harbor match? How can that help you? Also, is your employer contribution design flexible enough? So what can sometimes happen is the plan design has a very rigid formula in there where it's disadvantageous for the employer to make additional contributions. So they just leave it with the deferral and the match, all right? But with the right plan design, a larger contribution could be had by all and be at the advantage of the employer or owners. Okay.
And when plan design is off, it usually smells like fish. And it usually shows up in mistake number 4.
If you're a business owner who wants to ensure that their plan is fully functional, hitting on all 17 cylinders and healthy, you can download our 17-point checklist in the description below that will show you potential penalties, audits, and refunds hiding in your plan.
Mistake number 4, failing non-discrimination testing and other required tests.
Correct. So failing testing is mistake number 4. Now, this is often the moment employers realize their plan isn't as balanced as they'd hoped or
Dorothy,
thought.
we aren't in Kansas anymore.
No. Owners and highly compensated employees feel it first because refunds or forced corrections very often follow. Okay?
Nobody likes redoing their taxes.
No, they
they
don't. Nope, no.
Okay.
Now, are there ways to avoid failing non-discrimination testing and other testing? Of course there are. Okay, this is why we want to have the employer do a proactive review. This is why we have our clients consider mid-year testing. Okay, and you can also have a safe harbor contribution so that your highly compensated employees can defer as much as they want. You can do a safe harbor match or a 3% safe harbor. Then you don't have to worry about that testing requirement. There are still some others that need to be followed, but those are done based on how many employees you've got, what the plan design is, etc.
That brings us to the last mistake, which is super common among bigger businesses. Overlooking audit preparation.
Right.
Hey, are audits, just a walk in the park?
They can be. We got some vendors that help make them not so bad. I said not so bad. Okay?
Well, you got to prep.
Right, correct. Now, the 5th mistake is overlooking large plan audit preparation. Okay, so when we're saying audit, in this case now for mistake number 5, we are talking about the mandatory large plan audit that's done after the close of the plan year. Now, even employers who are convinced they're doing things right can struggle here because they poor documentation, poor processes, and their timing is all off. All of this matters. Now, the issue isn't just passing an audit, it's the extra stress, time, and disruption for the employer when things aren't ready. Okay, so make sure if you know you're going to have a large plan audit, let's put it this way: if you have over 100 people in your plan with an account balance, whether they're active, terminated, dead, disabled, whatever, doesn't matter. You have over 100 participants in your plan with any kind of account balance. Make sure you talk to your TPA to see what your audit requirements are before the end of the year and start planning for that audit for the following year. Now then, Catherine, so who is required to do an annual audit?
Employers who have a plan with over 100 people.
Almost. It's changed a little bit.
Well,
okay?
there's a sliding scale of this and that and this and that.
Okay.
Yeah.
So then, if it's the first plan year of your plan and you have over 100 participants with an account balance, at the end of the plan year, you're going to need an audit for that year and the next. How do you prepare for an audit? You make sure you have all of your amendments, signed plan documents handy. If you have any, whatever paper forms you had for the year, get them together. Beneficiary designation forms, distribution forms. If you've got anything in paper, make sure you know how to get into your payroll system to generate the reports that your auditor is going to want. Okay.
Is there a checklist for this?
Yes, but you know who it's going to be?
The
'Cause
auditors.
I was getting to that. That's what I was going to close with.
Okay.
How do you prepare for an audit? Pick an
Ask your
auditor
auditor.
and ask your auditor what they're going to want you to do for the first time. Okay?
And when we talk to an auditing firm, they really say that the best auditor is one that does multiple
A lot of them.
audits,
Yes.
right?
So
this isn't kind of like looking for the person one and done. It's not your cousin down the street who thinks they can take a swing at it.
Right. If you got somebody in junior college who thinks they're trying to be an accountant and they want to do your large plan audit, No. Okay, sorry.
Struggle is real. Don't do
The
it.
size matters. Okay, pick somebody who's done a bunch of these and/or is a focus of their practice.
So, Christopher, if there is one takeaway, what is it?
Most 401k mistakes are quiet and they compound over time. That's why we have put together a 17-point checklist you can download with the link below. Also, click on the link below to find our other video channels and podcasts. And of course, if you have a specific question about your plan, just email us at,
sales@hunterbenefits.com.
and most importantly, don't forget to keep those cards and letters coming.
Toodaloo.